The Thai outlook for 2024 will be an interesting one. We do expect that GDP growth will improve to 2.8% year-on-year versus an expected 2% in 2023. The boost to growth this year will come from consumption spending, namely private consumption. And this is largely because government policies are oriented to push private consumption. One of the biggest policies that the government is pushing this year is the introduction of the digital wallet, which is expected sometime in the second quarter of this year. Amongst other policies that the government has put in place to boost consumption are cost of living measures, which will cap the price of retail fuel as well as utilities, and at the same time introduce excise duty cuts to things like alcohol, all of which will help lower the cost of goods and improve spending. At the same time, tourism, which was one of the bigger supports to growth in 2023, will remain so this year. We have seen that the Thai authorities have introduced visa waivers for tourists from key destinations, including India and China. There is also talk that there will be a permanent visa waiver for Chinese nationals. All of this will help support exports of services, which is namely tourism. Goods exports will also be supported to some extent by the bottoming out of the electronics export down cycle. We expect this bottoming to come sometime in early 2024. The higher prices of commodities such as rice and sugar will also be of support to Thailand, which is a net exporter of these goods. The weak link in the growth story will remain investment spending. We do not expect investment spending to be a strong driver of growth, as we've not seen enough incentives for either the public or the private sector to boost investment spending. As a result of all the government's policies that have been announced and will take hold through the course of the year, inflationary pressures will remain depressed. Inflation will be heavily subsidized through most of this year, albeit rising from the negative prints that we've seen in the fourth quarter of 2023. The upshot of highly consumption-driven policy is the fact that the fiscal deficits will remain wide over the medium term, averaging close to 3.5% of GDP, and public debt levels will also remain elevated. While the government's focus is clearly prioritizing consumption spending, this will have a short-term boost to growth. It would also be prudent for the government to start prioritizing investment spending in the form of infrastructure development and FDIs in order to help credibly boost medium-term growth prospects. In terms of monetary policy, the government has made very clear that it would like the BOT to cut its policy rate from the current 2.5% in order to support growth and sync monetary policy with looser fiscal policies. However, the BOT for its part is not budging. It has made amply clear that policy rates will move only if the growth inflation dynamics demand so, and that rate cuts are associated with costs and risks which could have medium-term repercussions. Namely, household debt in Thailand remains extremely elevated and focused on consumption spending already, and a further cut to interest rates may spur further household debt, which is a concern for the BOT. In terms of our own forecasts, we expect the BOT to stand pat for the rest of the year and hold its policy rate at 2.5%. Eventually, decisions in the Bank of Thailand come down to the vote within the Monetary Policy Committee, which is the MPC. The MPC consists of 4 external members and 3 internal members. Our analysis of the votes of the members of the MPC suggests that most members are still in favor of keeping policy rates unchanged rather than voting for a cut. Hence, we remain of the view that BOT will be firmly on hold through the course of 2024, even with, say, the US Federal Reserve cutting interest rates. To summarize, our view is that there will be a modest improvement to growth this year, led by consumption-driven policies. Investment spending will remain subdued. Inflation will remain heavily subsidized, but lower inflation will not spur the BOT into action. If anything, we expect the BOT to stand pat through the course of 2024, largely because the government is already doing much of the heavy lifting, and fiscal deficits over the medium term are expected to widen, with public debt levels also expected to remain elevated.